Continuing on with the whole idea of metered annuities and everything, there are two things that you must know about metered annuities. Metered annuities can be purchased either on what we call prescribed or a non-prescribed basis. Another name for non-prescribed is what they call an accrual annuity. So you may see the word accrual instead of the word non-prescribed. Okay, so let's take a look at that. Let's take a look at the non-prescribed or accrual annuity, and let's see how it's treated from a tax perspective. Okay, from a tax perspective. So basically, let's say you gave me $500,000, and here's the block of money, essentially. Okay. Now, if you notice, there's a line here drawn right down here, because in an annuity, remember that the payment that you get is a combination of two things. It's a combination of interest and a combination of your cash. So part of your annuity payment will be a return of your own money, which means it's not going to be taxable. In other words, the ACB on that obviously is your own money, so you don't pay tax on your ACBs. Okay, but you're also going to get interest on that money, and of course that portion, the interest portion, will be taxable. Okay. So in an accrual annuity, so the same $500,000, here's your cash accumulation, here's the interest and everything. And so in the early years, you'll notice in the accrual part is that the first few years, much of the money that you get will in fact be interest income, which means basically you're going to have a big tax issue and everything else. So I'll give you an example. Let's say again, we agreed that we're going to pay you $5,000 a month for whatever period of time. It's not important at this point, okay? And because in the first year the interest rate is very high, so the interest is $4,000. Now let's assume that you're in a 50% tax bracket, again for sort of easy math. So after that $4,000, $2,000 is gone. Okay, so it's gone into taxes. So when you do the math, off the $5,000, really your take-home pay is only $3,000, basically. Okay, so it's not very tax efficient because a lot of your income, a lot of your money that you're getting, will in fact be interest income. So if you notice here, really it's only about $1,000. That's only $1,000. That's really your principal, where you don't have to pay any tax. The rest of it's all $4,000, all interest. You got to pay tax on that. $2,000 is gone. So therefore, in your pocket, basically, all you've got left is $3,000. Okay? So it's not a very tax-efficient type of system. So when you look at this, it's really like your mortgage. So think of a accrual annuity basically is a mortgage. So when an insurance company or when a bank gives you the money, so they give you a bag of money, let's say for $500,000, and go and buy your house, whatever it is, and then they give 25-year amortization. And if you'll notice that the interest in the first few years is quite substantial. So much of your money actually goes into interest. Very little of that goes to erode the principal part of it. It really doesn't begin to get a little bit exciting until roughly around the 15th year or so. Then you'll see that, more cash is being paid out, and less interest and everything. So when you look at an accrual annuity, think of your mortgage. It's the same idea. That's how you would remember the difference between one and the other. So mortgages are basically non-prescribed annuities or accrual annuities. So as you can see, the tax efficiency is the issue here as far as the annuity. So the Act allows us now to actually issue annuities on what we call prescribed annuity. So the same thing. It's a prescribed annuity, same $500,000. Okay, same income, $5,000. That doesn't change. Nothing changes from that perspective. It's only from a tax perspective that there's a big impact here. So if you notice that this particular line now is flatlined all the way through, and so that basically means that all of this interest in here is still going to be the same, except that we're going to pay it out. Okay, it's going to be amortized, you might say, over the length of the annuity period. Okay, and so therefore we basically streamline the annuity all along. So you don't get, first year you get $4,000, the second year is $3,350, whatever of interest. In other words, the decline in scale, just like your mortgage does. Here, it's going to be the same all the times. And so once again, like any other annuity, its interest plus cash is going to be what's paid up. So you're still going to get the same 5,000 as you were getting here. It's from a tax perspective that it gets exciting. Basically, let's say the interest now is $2,000 instead of the original $4,000. But it'll always be $2,000 every single year, because remember, it's amortized the entire length of the annuity period. So you now know from a tax planning, budgeting, and all that, you know that every single year you've got a $2,000 expenditure every single month that has to be factored in. So the same 50% tax bracket, so minus $1,000. Once again, you do the math on this here, and you end up at $4,000. So here, on an accrual annuity or non-prescribed, you only have $3,000 to actually spend. Here, you've got $4,000 to actually spend. So in a prescribed annuity, it is more tax efficient. And that's the main element here. The difference between these two is the tax efficiency aspect. A prescribed annuity is more tax efficient. A non-prescribed or accrual annuity is not tax efficient. So really, it's really a choice that you make. So when you're going to the company, they will ask you, do you want it prescribed or do you want it non-prescribed? Now, always remember that when we're talking prescribed and non-prescribed, we are talking about non-registered money. Okay, so this is what they refer to as open money, because in an RSP, which we'll talk about in other sessions and everything, there's no such thing as prescribed and non-prescribed. In an RSP, if you remember, everything is taxed, the whole thing. So this kind of thing here doesn't work at all if it's registered, if it's a registered annuity. So this money is really an immediate annuity that is a non-registered annuity. You get into this situation. But in any kind of a registered type of plan, the adjusted cost base is zero. So that basically means that everything is going to be taxed. The entire amount is going to be taxed. So there's no such thing as prescribed and non-prescribed in a registered annuity. But in a non-registered annuity, which is what we're talking about here, you get into that question. So the advisor will say, Mr. Jones, you want it prescribed? Here it is. Non-prescribed? Here it is. What is your choice? Now, basically, and you can decide from there, depending on your particular tax situation. And we'll see you next time. We'll talk about deferred annuities.